Good morning, everyone, and welcome. I call this September 2020 meeting of the Ncua Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public via a live webcast only. The public may access the meeting by visiting the agency's homepage and clicking on the provided webcast link. I'd also like to note that all participants in today's webcast meeting are participating remotely. I'd now like to focus on our agenda. The first item on our agenda today is the Share Insurance Fund Quarterly Report. Staff presenting: Eugene Sheed, Chief Financial Officer, and Vicki Norwald, Supervisory Risk Management Officer from the Office of Examination and Insurance. Good morning and welcome.
Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. This is Eugene Sheed, and I am here to present the 2020 second quarter statistics for the Share Insurance Fund. Slide 2. The first table shows the insurance fund's revenues and expenses for the second quarter of 2020. For the quarter ended June 30th, the fund recorded net income of $19.3 million. Total income of $72.1 million consists primarily of investment income from Treasury securities of $69.7 million. Additional income sources include $2.2 million collected for guaranteed fees on the Ncua Guaranteed Notes Program, or the NGNs. Operating expenses were $45.7 million for the quarter. The provision for insurance loss reserve expense decreased by $6.4 million during the quarter, and I will discuss that further on slide 4. During the quarter, the fund recorded a $5.4 million adjustment to the asset management estate loss expenses for natural person credit unions, which was related to loan sales. The loss expense for corporate credit unions increased by $8.1 million due to unfavorable changes in estimated future cash flows for the assets held by certain asset management estates. Slide number 3. This table shows the Share Insurance Fund's balance sheet as of June 30th, 2020, compared to the previous quarter. As of June 30, total assets are valued at $17.7 billion, of which 98.7% are funds held with the U.S. Treasury in cash, overnight investments, and Treasury notes. Overall, total assets decreased by $8.8 million, largely due to decreases in the corporate AME receivable and accrued interest revenue for Treasury investments. The net receivable for asset management estates is $149.9 million. The receivable from the corporate asset management estates decreased $20.7 million from the previous quarter due to cash collections and a decrease in cash we expect to collect in the future. The receivable from the natural person asset management estates increased by $7.7 million, primarily due to increases in future cash collections. Accrued interest in other assets is $84 million, which decreased 6% from March, largely due to a decrease in Treasury investment receivable. Total liabilities are $188.8 million, or 1.1% of total assets. Accounts payable and other liabilities of $4.8 million primarily consists of credit union refunds on cap deposits of $4 million. The fund's net position is comprised of capital deposits, which represent the total balance of all federally insured credit unions' 1% capitalization deposits and the cumulative results of operations. The net capital deposit activity increased by $3 million this quarter. Cumulative results of operations increased $27.3 million during the quarter due to an increase in unrealized gains on investments of $8 million and a $19.3 million net income for the quarter. Slide 4. The fund records insurance program liability, which is comprised of a general and specific reserve to cover losses resulting from insured credit union failures. Each quarter, the fund assesses reserve needs for credit union failures and makes a reasonable estimate of losses. During the quarter, the reserve expense decreased by $6.4 million. This decrease is attributable to a decrease in the general reserve of $8 million, offset by an increase in the specific reserve of $1.6 million. Overall reserves increased during the second quarter from $177.7 million to $184 million. Of the total ending reserve balance as of June 30, $20.5 million is for specific reserves and $163.5 million is for general reserves. Slide 5. Through the second quarter of 2020, there was one credit union failure that incurred a loss to the fund. The failure was an involuntary liquidation with a purchase and assumption agreement. The cost of the failure for 2020 is $1.6 million. Fraud was a contributing factor in the failure that occurred in 2020. Slide 6. As of June 30th, 2020, the Share Insurance Fund had $16.6 billion at par value invested in Treasury securities with maturities out to May 2027. The average weighted life of securities held by the fund is 3 years. The weighted average yield of securities held by the fund decreased 10 basis points from the last quarter to 1.63%. The lower bar chart shows the cumulative picture of how much of the portfolio will mature over time. About 76% of the portfolio will mature over the next 5 years. During the second quarter of 2020, 8 Treasury notes matured in the amount of $900 million. These securities had yields ranging from 1.15% to 2.81%. Slide 7. The next few slides I'll use to address the equity ratio. Turning to the equity ratio chart on slide 7, the equity ratio is 1.22% as of June 30th. Per policy, the equity ratio is updated on a semi-annual basis. The blue line running across the chart represents the normal operating level, which remains at 1.38%. Slide 8. This slide shows the pertinent passage from the Federal Credit Union Act that defines the equity ratio. The second bullet references the applicable Ncua regulation and expresses the equity ratio in an abbreviated mathematical formula, which I will go into in greater detail on the next slide with our results as of June 30. Slide 9. This slide shows the second quarter Share Insurance Fund equity ratio calculation based on June 20 preliminary and unaudited financial statements and June call report data as of August 13th, 2020. From December 2019 to June 2020, the equity ratio decreased 13 basis points from 1.35% to 1.22%. Comparing June 2019 to June 2020, the equity ratio decreased 11 basis points from 1.33% to 1.22%. The primary driver of the change in the equity ratio is attributable to significant growth in insured shares during the first 6 months of 2020 at a non-annualized rate of 12.95%. The equity ratio is calculated using an insured share base of $1.4 trillion. The sum of the contributed capital and retained earnings, less contingent liabilities, also increased but at a much lower rate than did insured shares, by about 1.88% from December 2019. This led to a reduction in the equity ratio. Slide 10. A few final notes on the equity ratio. Each insured credit union pays to maintain with the share insurance fund a capitalization deposit amount equal to 1% of its insured shares. The Ncua updates the amount of each federally insured credit union that they must keep on deposit with the fund in order to maintain the 1%, which we do through 2 billing cycles. Cycle 1 includes capitalization adjustments for all insured credit unions done in the spring, and Cycle 2 in the fall includes only the adjustment for credit unions with assets of $50 million or more. If a credit union's shares increase, we invoice them the balance necessary to maintain the 1% capital deposit. If their shares decrease, we refund the difference needed to maintain the 1%. Based on the extraordinary growth of insured shares during the first 6 months, the fund will bill for a net of $1.5 billion later this month to true up the 1% deposit. Slide 11. The Camel data presented on the following 3 slides is current as of June 30th, 2020. This slide shows the distribution of insured shares by Camel codes from 2014 through the second quarter of 2020. The area in the graph at the upper portion of the slide, the red portion of the graph, is the percentage of insured shares at credit unions with Camel codes 4 and 5. The green represents the percentage of shares held at credit unions with a Camel code 3. And the blue represents the percentage of insured shares at credit unions with Camel codes 1 and 2. The chart underneath the area graph displays the total number of credit unions by their respective Camel code. Total shares at credit unions that are Camel code 4 and 5 are $9.5 billion, or 0.68% of all insured shares. This is a decrease of 9 basis points from the prior quarter. Total shares at credit unions that are Camel code 3 are $38.9 billion, or 2.18% of all insured shares. This is a decrease of 18 basis points from the prior quarter. Total shares at credit unions that are Camel code 1 and 2 is $1.3 trillion, or 96.51% of all insured shares. This is an increase of 26 basis points from the previous quarter. Slide 12. This slide compares credit unions' Camel codes by asset size. Camel code 4 and 5 credit unions are shown on the left-hand side, whereas Camel code 3 are displayed on the right-hand side. Comparing Camel code 4 and 5 credit unions by asset size from March 2020 to June 2020, the number of these credit unions with assets ranging from $100 million to $500 million increased during the quarter. The number of Camel code 4 and 5 credit unions and all other asset size categories decreased. Total insured shares remain the same from the previous quarter for credit unions Camel code 4 and 5, while the total assets decreased from $10.4 billion to $10.3 billion. Comparing Camel code 3 credit unions by asset size from March 30 to June 2020, the number of credit unions with more than $1 billion in total assets remained unchanged from the prior quarter. The number of credit unions with $500 million to $1 billion increased during the quarter, and the number of credit unions coded Camel 3 in all other asset categories decreased. For credit unions Camel code 3, total shares increased from $36.6 billion to $38.9 billion during the quarter, while their total assets of the Camel 3s increased from $42.6 billion to $44.6 billion. Slide 13. This slide shows the distribution of assets by Camel code from December 2006 through June 2020. The red band across the top of the chart is the percentage of total credit union assets that are credit unions with Camel codes 4 and 5. The green represents the percentage of assets at Camel code 3 credit unions, and the blue represents the percentage of credit union assets that are held at Camel coded 1 and 2 credit unions. The distribution of assets over the last quarter for Camel 1 and 2 credit unions increased from 96.6% to 96.9% of total assets. Camel 3 credit unions decreased from 2.7% to 2.5% of total assets, and Camel Code 4 and 5 credit unions' share of total assets decreased from 0.7% to 0.6%. That concludes my presentation, and I will be happy to answer your questions.
Great. Well, thank you for your presentation this morning, Eugene. As we all walk through the unfolding events of these current economic times, the quarterly updates on the Share Insurance Fund are an important source of information for the board, along with our public stakeholders. These presentations provide transparency into the condition of the fund and provide insight into the health of the overall credit union industry. There's been growing anticipation around the performance of the Share Insurance Fund following the economic impact of the COVID-19 pandemic. Based on today's presentation, the NCUA remains above the minimum equity ratio of the Share Insurance Fund, but I must say that vigilance is needed to manage and monitor this situation. As the result of extraordinary growth in insured shares during the first and second quarters of 2020, we see from today's presentation that the equity ratio has seen a significant drop from where it was as of December 31st, 2019. The equity ratio has declined from 1.35% down to 1.22%. I understand the FDIC faces a similar situation, and with the Deposit Insurance Fund falling below its minimum reserve ratio of 1.35%. This in turn caused the FDIC to create a restoration plan for their Deposit Insurance Fund. With that in mind, I'd now like to begin with a few questions. Eugene, if you could go back, please, to slide 7 of the presentation. And I believe that's the slide, yes, that's the slide that shows the changes to the equity ratio since 2014. And this decline is the largest that the NCUA has seen during that period. If the equity ratio were to drop below 1.20%, what plan of action would the agency take?
Okay, thank you for that. So when the equity ratio falls below 1.2%, the NCUA, or we project that staff projects that it will fall below 1.2%, then a restoration plan, like you were just referencing with the FDIC, we would likewise have to develop a similar restoration plan that would describe how NCUA would restore the equity ratio above the 1.2% over a period of time, which would be over up to the next 8 years. And that's my answer to that. Back to you, Chairman.
Great, thank you. Could you please provide some additional clarification around the cause of the decline and the impact that you expect will result from the semi-annual capital deposit adjustment?
Sure, absolutely. So again, as I was elaborating in going through the formula and what drives and what has driven the equity ratio decline during the first half of this year, as we see, and you can see in various points throughout the presentation, the result is due to the very strong share growth, growth in insured shares of nearly 13%. In terms of losses, as I pointed out in one of the earlier slides, there have been just the one. Our reserve needs have not appreciably changed for the quarter, so it's totally being driven by the growth in insured shares. We will bill, as I mentioned, later this week and collect next month cap deposit adjustments that net $1.5 billion. So that will have the effect of essentially increasing the equity ratio, although we don't formally reestimate and report on the equity ratio again until December 31. Back to you, Chairman.
Great, thank you. And Eugene, remaining on slide 7, I see that there was a significant decline in the equity ratio at the end of the June 30th, 2018 reporting period. How does the recent decline compare to the 2018 decline? Are there any similarities?
So I would say there's actually not a lot of similarities other than, that's the other significant decline that's happened. So those, what you are referencing from 2017 into 2018 is similar in magnitude to what we're seeing now. But the reasons, of course, quite a bit different. This one, as we've been discussing, is due to a strong growth in insured shares. Really the primary driver of the reduction, the earlier reduction that you're referencing, was due to the distribution that Ncua did, that the board had approved for 2017, which returned over $700 million to credit unions, and that lowered the equity ratio, and so that was the primary driver in that reduction. Back to you, Chairman.
Thank you, Eugene. I'm going to address this question to you, Vicki. So good morning, Vicki.
Good morning, Chairman.
I understand that the FDIC's Deposit Insurance Fund is facing a similar situation. Can you please provide a brief comparison between the two funds in terms of what they are currently experiencing and how they are managing their fund?
Certainly, I'd be happy to do that. So I'll start with the management of the funds. The Ncua and the FDIC have similar congressional mandates for managing their insurance funds. As you are aware, the Ncua must maintain its equity ratio between 1.2 and 1.5%. The share insurance fund's equity ratio, consists of a capitalization deposit equal to 1% of credit union's insured shares and retained earnings from the fund's operating results. The Ncua board periodically sets the share insurance fund's normal operating level, which is the desired equity level for the share insurance fund, in accordance with the Federal Credit Union Act, between 1.2 and 1.5%. The normal operating level is currently set at 1.38%. If the equity ratio falls below 1.3%, Ncua may assess an insurance premium to insured credit unions to restore the equity ratio up to, but not above, 1.3%. The equity ratio may only increase above 1.3% through an increase in the share insurance fund's retained earnings or a decline in insured shares. If the board projects the equity ratio will, within 6 months of determination, fall below 1.2%, or if the equity ratio actually falls below 1.2%, Ncua must establish and implement a restoration plan within 90 days to restore the equity ratio to and maintain that ratio at 1.2%. In the event insured share growth or anticipated losses should prompt the equity ratio to fall below 1%, Ncua would require insured credit unions to recapitalize the share insurance fund in addition to Ncua assessing insurance premiums. If the equity ratio were to exceed the normal operating level, Ncua must effect a pro rata distribution to insured credit unions. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was the most recent mandate for the FDIC Deposit Insurance Fund. The Dodd-Frank Act requires the FDIC to establish a minimum designated reserve ratio, or DRR, of 1.35% of estimated insured deposits, or the comparable percentage of the new assessment base. Like the Ncua, if the designated reserve ratio falls below 1.35%, or if the FDIC projects that the designated reserve ratio will, within 6 months, fall below 1.35%, the FDIC must adopt a restoration plan that provides the deposit insurance fund will return to 1.35% within 8 years. The FDIC has the authority to declare dividends when the DRR at the end of the calendar year is at least 1.5%, but grants the FDIC sole discretion in determining whether to suspend or limit the declaration or payment of dividends. In terms of what the funds are experiencing, the FDIC and Ncua both had unprecedented growth in insured deposits during the first 6 months of 2020 due to government policy actions in response to the pandemic, changes in spending, stay-at-home orders, and a flight to safety. The FDIC designated reserve ratio at March 2020 was 1.39% and fell to 1.3% at June 30, 2020. The 1.3% is less than the statutory minimum of 1.35%. So the FDIC approved a restoration plan on September 15, 2020, and will post it in the Federal Register for public comment. FDIC insured deposits grew 13.08% from December 31st, 2019 to June 30th, 2020, compared to a historical average growth rate of 4.5%. Similarly, Ncua experienced a decline in the equity ratio at June 30, 2020 from 1.35% at December 31, 2019. Insured shares grew 12.95% in the first 6 months of 2020 compared to a historical average growth rate of 4.58%. And that concludes my response.
Great. Thank you, Vicki. That's a really excellent overview of the FDIC's Deposit Insurance Restoration Plan. So now let's shift gears back to our agency. Could you please recap what would cause the Ncua to need to create a funds restoration plan?
Yes, sir. The Ncua would be required to develop a fund restoration plan if the equity ratio were to fall below 1.2% or if we project it to fall below 1.2% within 6 months. Thank you. Back to you.
Thank you. And I want to follow up on that a little more. And as I preface this, I recognize that you're not a clairvoyant or a soothsayer, but based on what you know today, do you foresee the Ncua needing to start creating a fund restoration plan at this particular time?
Thank you, Chairman. Because the Ncua equity ratio at June 30, 2020 of 1.22% is higher than the statutory minimum of 1.2%, no restoration plan is required at this time. Additionally, the official equity ratio calculation was based on actual insured shares at June 30, 2020, but insured credit unions will adjust their capitalization deposit to reflect the aforementioned share growth in October. This lag was reflected in the decline to 1.22%. Had capitalization deposits been adjusted in June instead of October, the equity ratio would have been 1.33%. Ncua calculated the projected equity ratio for December 31, 2020 at 1.32%, including the anticipated capitalization deposits, forecasted insured share growth, and equity values. The projected equity ratio analysis is partly based on a set of assumptions. Actual results are unknown and dependent upon multiple variables. We continue to evaluate how a variety of stress scenarios impact the share insurance fund performance in the event a fund restoration plan becomes necessary. Thank you. That concludes my response.
And thank you. And I have no further questions. I'd now like to recognize Board Member Harper. Good morning.
Good morning, Chairman Hood. And thank you, Eugene and Vicki, for your candid briefing and answers about the performance of the Share Insurance Fund during the last quarter. Ensuring the share deposits of members and safeguarding the share insurance fund from losses are two of our most important duties on the NCUA board. In recent years, we have built up the reserves of the fund in anticipation of an economic downturn. Nevertheless, your assessment on slide 7 that the equity ratio of the share insurance fund has fallen so quickly to 1.22% gave me a bit of a start. We are just a thin hair's width of 2 basis points above the statutory trigger requiring the NCUA board to develop and implement a restoration plan for the share insurance fund. And I agree with Chairman Hood that vigilance is needed. The drop in the share insurance fund ratio of 13 basis points in the first half of the year was sizable and perhaps unprecedented. I want to ask the question on slide 7 a slightly different way from the chairman. Vicki and Eugene, when have we previously experienced a more than 10 basis point drop in the semi-annual calculation because of share inflows?
This is Vicki. I will take that question. Previously, the NCUA has not seen a more than 10 basis point drop in the equity ratio attributed specifically to share growth. We did have an 11 basis point drop in the equity ratio in 2018, but as Eugene pointed out, the majority of that decline was a result of a premium of a distribution that year. Only 4 basis points of that 11 basis point decline was attributed to share growth. That concludes my response.
Thanks, Vicki. And what that tells me is we're dealing with a black swan situation here, something which we've not seen before and something which we couldn't anticipate. As Chairman Hood noted, I understand that the FDIC's reserve ratio for the deposit insurance fund, the fund responsible for covering depositor losses and administrative costs when a bank or a thrift fails, had a similar sizable contraction between the first and second quarters of 2020 because of a surge in deposits. As a result, the deposit insurance fund fell 5 basis points below its statutory minimum equity ratio, and the FDIC has begun to work to restore the deposit insurance fund to its minimum level of 1.35%. Vicki, if the NCUA's share insurance fund were to fall 5 basis points below the 1.2% equity ratio, and if the NCUA board decided to charge a premium of 5 basis points in one assessment to restore the share insurance fund, what would a federally insured credit union with $10 million in insured shares pay? And how about a credit union with $50 million or $250 million of insured shares?
Thank you, Board Member Harper. If the NCUA were to assess a 5 basis point premium on its insured shares, the cost to credit unions would be $500 per $1 million in insured shares. So that equates to $5,000 for a federally insured credit union with 10 million in insured shares, $25,000 for a credit union with 50 million in insured shares, and $125,000 for a credit union in insured shares.
Vicki, that's really helpful. I know that we've got some really large credit unions that are above $10 billion in insured shares. What would one of those credit unions pay, assuming that it had $10 billion and only $10 billion in insured shares?
Sure, thank you. A credit union with $10 billion in insured shares would pay $5 million. And
that's a sizable amount of money. So thank you for that, Vicki. Let's turn to slide 3 in the slide deck. In your presentation, you indicated that credit unions will soon true up their 1% capitalization in the share insurance fund. How does the true up work? How much money do we anticipate coming into the share insurance fund? And what would be the total assets of the share insurance fund after the true up?
Okay, this is Eugene. I'll take that one. So working through kind of the questions you've just asked there, based on the June 30th call report data, what we do is reassess credit unions' insured shares against their capital deposit that they already have with us to determine if they need to increase that amount or whether we owe them a refund for this current cycle that we're going through. And again, so second, we do it in 2 cycles. First cycle, spring, everybody. Second cycle, fall, only those with 50 million or above in insured shares. And so what we're looking at for this cycle is a net collection of $1.5 billion, which is the net of all of the invoices we'll send out against the refunds. There's actually very few refunds. So for this upcoming cycle, I believe we'll be invoicing 2,342 credit unions based on their growth, and we'll be just providing refunds to 42. So virtually all credit unions are going to get an invoice, and it'll be $1.5 billion. If you then run that math through the equity ratio calculation that was on slide 9, and you add in the $1.5 billion, that would be added into the numerator, which would increase it from, I believe, $16.9 billion to $18.4 billion. And as Vicki alluded to in one of her earlier answers, that's effectively an increase of about 11 basis points. That concludes my answer.
Thank you for that answer, Eugene. I think that's helpful for us to understand where the money is going to end up at. If we could turn to slide 6. In a speech earlier this week, I said that because of the coronavirus-induced economic fallout, we must all prepare for increased member delinquencies, loan defaults, consumer and business bankruptcies, and even credit union failures. If one or more insured credit unions failed in the months ahead, we may need to quickly access the reserves of the Share Insurance Fund portfolio to cover insured deposits. Moreover, we will need to wind down the Ncua Guaranteed Notes program in the near future. In recent months, I have often encouraged credit unions to take the steps needed to ensure that they have access to liquidity, and I've encouraged them to join the Central Liquidity Facility. But I'm now interested in learning more about how we manage the liquidity of the Share Insurance Fund to cover such knowns as the Ncua Guaranteed Notes wind down and the unknowns of credit union failures over the next year. Eugene, would you walk me through whether we have sufficient liquidity? Additionally, what might happen if we had the failure of a large credit union? How would we access the additional money in our reserves, and at what price?
Sure. So you're referencing slide number 6, and you can see the profile of our investment fund by over a series of time. And you can see it's weighted to the front end, and that's a conscious decision that we made because of the factors that you were just mentioning about the NGN wind down plus the economic uncertainty. So Ncua leadership, which includes not only myself, but also representatives from examinations and insurance and the chief economist, we meet regularly to assess our investment strategy and our positioning for the Share Insurance Fund. And so we consciously are looking at slides like slide number 6, taking into account a vast array of economic data, trying to anticipate what might lie ahead, taking into account some of the more known factors, such as the NGNs, to position ourselves. So we consciously have structured the portfolio to have liquidity ready for the NGN programs and also to be sort of at the ready in terms of potential losses that we might see. So you see that there's a significant portion of the portfolio that's either in overnights or maturing within the next year. And we think at this point, based on what we see, that'll be sufficient Were it not to be sufficient, if we were to underestimate the need, then we would look to the rest of the portfolio and determine which assets or which Treasury securities we might want to sell, taking into consideration, of course, things such as, how those the yields on those and how they're performing. And so we could liquidate other of the securities as we need to. At this point, given interest rates and our investment ladder, we're actually in a pretty positive position if we needed to do that. But at this point in time, we don't foresee that need. Back to you, Mr. Harper.
Thank you, Eugene. And your answer that we've anticipated what we believe to be the case and that we've positioned ourselves so that if we need to do more are a bit of good news for me and certainly will help me to sleep easier at night. Now, let's turn to slide 13. Vicki, over the coming year, can we anticipate the distribution of assets by Camel code to remain the same as it was in the last quarter, or will it move more like it did after the 2008 financial crisis and into 2010, where we're going to see more red and green on this chart?
Thank you for that question. So future changes in Camel ratings remain uncertain as the length of the pandemic and the resulting potential economic effects on credit unions are unclear. A few of the uncertainties include the length of time necessary for a full economic recovery, how quickly businesses reopen and return to pre-pandemic operations, and consumer behavior during and after the pandemic, which could have longer-term effects on the financial services industry. This environment differs from 2008 in many different ways, but federally insured credit unions' capital position is strong at 10.46% at June 30th, 2020, exceeding the regulatory minimum of 7% to be considered well capitalized. While economic stress related to COVID-19 has lowered net interest margins, impacting earnings, asset quality and capital adequacy remain strong, and we continue to monitor the impact of COVID-19 on our insured credit unions very closely.
Thank you, Vicki. Is it also true that the Camel code rating can be a lagging indicator of what's actually happening at a credit union?
Yes, as a function of our supervisory efforts, the Camel code is often updated somewhat after the fact. We'll often see the economic impact occur first before we have an opportunity to respond with a change in ratings. So yes, thank you.
Yeah, no, I appreciate those observations, and we may well be seeing a calm before the storm, but I take all of your points very well that we just don't know yet exactly how this chart is going to play out. Finally, I know that under your leadership, Eugene and Vicki, the Ncua staff are actively modeling the effects of the dramatic rise in assets, falling loan demand, compressed interest rates, decreased earnings, and subdued consumer confidence. There is, however, great uncertainty about how the economic effects of the pandemic will unfold over the long term. After all, we have many, many moving parts, and I think, Vicki, you were alluding to that earlier. In the short term, the Ncua board must be prepared to charge a share insurance fund premium should future events warrant it, and credit unions need to be made aware of that reality. But in the long term, I think it is important that we begin a discussion with Congress about modifying the way in which we manage the share insurance fund. In managing the deposit insurance fund, under its statute, the FDIC has higher reserve requirements, greater flexibility, and the ability to charge risk-based premiums. In my view, those are sensible policies. The agency, therefore, should review its options and reach a conclusion about what statutory changes make the most sense for us to pursue. Additionally, I am concerned about the current law's cyclicality. Although the Federal Credit Union Act requires board action when the equity ratio falls below 1.2%, or as you noted, will fall below is projected to fall below 1.2% within the next 6 months. Charging premiums for share insurance during the midst of an economic downturn is less than optimal. Vicki, would you discuss the benefits of putting the share insurance fund on a countercyclical footing? And would you outline how increased flexibilities for the NCUA in managing the fund might improve its performance?
Sure. So as mentioned previously, the Dodd-Frank Act raised the minimum equity level for the FDIC deposit insurance fund and removed the upper limit. Additionally, risk-based premiums are computed on assets instead of insured deposits. Finally,
Sure.
The Dodd-Frank Act provides the FDIC with sole discretion to suspend or limit declaration and payment of dividends. What this means is options such as these for the share insurance fund would conceivably provide the board with increased flexibility in maintaining the share insurance fund through varying economic scenarios. This would provide the ability to operate counter-cyclically, building up the share insurance fund in strong economic times without the need to assess premiums while credit unions are experiencing losses. Currently, the NCUA can only grow the share insurance fund beyond 1.3 through a decline in insured share or investment earnings and only up to the pre-established normal operating level, but never higher than 1.5. Finally, in theory, risk-based premiums also more equitably shift the cost of insurance to higher risk institutions. Thank you, sir.
Oh, thank you, Vicki. Those insights were really useful. As a former Boy Scout, I long ago learned that the best time to repair the roof is when the sun is shining. Why wait for storm clouds to roll in before we build reserves? Moving forward, the NCUA should seriously consider how we can allow for the accumulation of reserves during good times to cover losses in bad times without falling below the minimum statutory equity ratio. With more advanced funding of the share insurance fund, we would be helping credit unions avoid paying premiums during economic downturns. Doing so will allow them to continue lending and cover added expenses during tough times. With that, Mr. Chairman, I have no further remarks or questions. Thank you.
Thank you, Mr. Harper. I'd now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. As I previously noted, I am apprehensive about the downward trend in the equity ratio. It is my understanding that the reduction referenced in today's briefing was caused in part from an increase in the denominator of the equity ratio fraction triggered by COVID-related flight to quality share growth, and that this downward pressure is projected to reverse in part at the end of the year as the new 1% capital deposits are funded by the credit union community. My concern continues into 2021 and is driven by a repeat of share growth 1% capital deposit timing mismatch, plus, more importantly, the potential decrease in the numerator of the equity ratio fraction caused by COVID-related credit union losses and failures and the continuation of the low interest rate environment. The latter two issues may not reverse by the end of 2021, as their resolution is dependent upon the underlying financial strength of the credit union system, the overall health of the economy, and monetary policy. Regrettably, it is not alarmist to foresee the equity ratio dipping below 1.20 in 2021, with far-reaching statutory consequences, including the possibility of future credit union premium assessments. It's also unlikely, based upon current analysis, that the adverse trend in the equity ratio will be offset by excess funds derived from the maturity of the final NCUA guaranteed notes, or NGNs, in 2021. The NCUA should work with all constituencies of the credit union community to address these critical issues in a transparent manner so as to mitigate the need for future premium assessments, particularly during the period in which credit unions are operating with the negative economic consequences of the COVID-19 pandemic. The agency should also continue to thoughtfully and thoroughly monitor the liquidity and capital needs of credit unions throughout the system and further refine its contingency plans as appropriate, as it's unlikely that we will truly appreciate the adverse consequences of the COVID-19 pandemic until early 2021 or later. We should remain vigilant and prepared to modify our modeling methodologies and strategic and tactical responses as the facts and circumstances develop. It is worth noting that the normal operating level and the equity ratio both equaled 1.39% following the merger of the temporary corporate credit union stabilization fund into the National Credit Union Share Insurance Fund. At that time, some advocated for the Ncua to set the normal operating level at or below 1.30% and distribute funds so as to drive the equity ratio to that level. Some even spoke of setting the normal operating level and equity ratio at or much closer to 1.20%. If the board had voted to follow that approach, the equity ratio would surely have fallen to well below 1.20% by now, with the heightened likelihood of material credit union premium assessments. By increasing the normal operating level and equity ratio to 1.39%, when funds were available from the merger of the stabilization fund into the share insurance fund, the board created, in effect, a prudent safety net reserve that may serve to protect credit unions from future assessments at a time of economic stress when they are least prepared to fund additional premiums. If assessments are nonetheless required, the safety net reserve should lessen the blow. These reserves were designed and implemented to protect against adverse consequences arising from credit union losses and failures, economic downturns, unknown unknowns, and black swan events such as the COVID-19 pandemic. It's fortunate that the reserves have been available to the agency and the credit union system during the pandemic. Mr. Chairman, I would also like to note that the FDIC has been continually making assessments to build their insurance fund. As such, the 1% deposit by the FDIC or more is a true deposit. Credit unions get to double count the deposits as assets on their books and also as assets of the share insurance fund. So when we compare the FDIC fund to the National Credit Union Share Insurance Fund, there are material differences. I have stated that we should strongly begin considering the development of a restoration plan at this time. I don't intend to sound alarmist, but we should not put our heads in the sand and ignore the reality of the decrease in the equity ratio as well as the substantially unknown consequences of the COVID-19 pandemic. We need to focus on the economic consequences of the pandemic and how this may materially and adversely affect the equity ratio. This is far more important than the mere timing differences in the share growth deposits. Mr. Chairman, that's all I have, and I have no questions. Thank you.
Thank you very much, Mr. McWaters, and I certainly appreciate your observations. And I must say that since I have a few more years on the board, I'm sure I will be able to actively address a lot of the issues as it relates to our insurance share fund. So thank you. Ladies and gentlemen, now let's move on to our second item. The second item on our agenda is a board briefing on the Modern Examination and Risk Identification tool known as MERIT. Staff presenting, Rendell Jones, Deputy Executive Director, Rob Foster, Chief Information Officer, and Kelly Lay, Director, Office of Business Innovation.
Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. This is Deputy Executive Director Rendell Jones. It is our pleasure to be with you today and provide an update on the Ncua's Enterprise Solution Modernization Initiative. In addition to providing an overview of the program, our presentation today will focus on the developments and status of replacing Ncua's legacy examination application with the modern examination and risk identification tool, also known as Merit. The Enterprise Solution Modernization Program was established in 2015 to help Ncua staff do their jobs better of regulating and supervising credit unions better and smarter. The program's purpose is to modernize Ncua's technology solutions to create an integrated examination and data environment and facilitate a safe and sound credit union system. The modernization aligns with Ncua's goals to, 1, reduce the burden on credit unions and increase agency efficiency by reducing on-site examination time, 2, improve off-site supervision capabilities with better data and analytics, 3, provide consistency and standardization for the examination and supervision process with modernized, flexible applications, and 4, improve communications between Ncua credit unions and our state supervisory authority partners. The Enterprise Solution Modernization Program is probably the most complex program undertaken by Ncua, certainly from a technology perspective. It's a heavy lift for Ncua, which requires coordination, oversight, leadership, and partnership. It truly is a program that will impact all Ncua staff, state examiners, and credit unions. For this presentation, we will discuss the 3 key projects, including the Examination and Supervision Solution, the Data Collection and Sharing Solution, and the Enterprise Data Reporting Solution. Our IT and business professionals reviewed the scope of the Enterprise Solution Modernization Program and prioritized the most critical legacy applications to modernize first. Our legacy examination application, ARIES, which is over 20 years old, quickly rose to the top of that list. At the time, we also prioritized the need for a single point of entry to interact with the Ncua and access Ncua applications in a secure, modernized infrastructure to create a technical foundation for all future system modernizations. Ncua regulates and insures credit unions from the smallest all-volunteer-based institutions to very large, complex financial institutions. And as we embarked on our market research for an ARIES replacement, we knew we needed a flexible, scalable, and user-friendly solution to support our examination and supervision programs. Analytics capabilities have advanced over time, and we also wanted to provide better information to examiners to help them identify and focus on the greatest risks in credit unions. We also wanted a solution where we could interact securely with credit unions to provide for efficiency in the examination process in support of our goals to have more off-site examination work. Although the project started before COVID-19, in response to the pandemic, the agency moved to an off-site posture in March 2020. During this time, examiners work with credit union staff to facilitate the secure exchange of information needed to conduct off-site examination and supervision functions. Merit provides the capability to securely share documents with examiners and complements the virtual examination initiative that seeks to promote a model to enable examiners to review a credit union's operational and financial condition from an alternative work site, such as a home office. Ncua's Chief Information Officer, Rob Foster, will now share with you more details about the project. Rob?
Thank you, Rendell, and good morning, Chairman Hood, Board Member Harper, and Board Member McWaters. This is Rob Foster, Chief Information Officer, and I'll be briefing the project overview and security slides. To support the agency and business application goals, we needed a secure and scalable infrastructure that provided seamless integration between legacy systems, highest quality performance, redundancy, and reliability. The reusable foundation is critical for the legacy application to be modernized under the ESM umbrella, but also for future technology solutions needed for the virtual exam initiative. As part of this project, we also implemented a central user interface where credit unions and state supervisory authorities can securely interact with Ncua. This interface authenticates and authorizes users with layered security and multi-factor authentication. It is reusable and scalable, and we anticipate adding more applications in the future to provide a single point of entry for users to interact with Ncua. To add efficiency to the user management process, we also developed and deployed an administrative portal, which provides confirmed delegated credit unions and state supervisory authority administrative users the ability to add and manage users to the Ncua Connect for their organization. This application delivers operational efficiency by alleviating the need for Ncua resources to add users and reset passwords and other functions. Although this puts more responsibility on the credit unions and state supervisory authorities to remove obsolete users, active users of Ncua Connect will realize the benefits of more immediate access to the applications with this decentralized user model. And as previously mentioned, we modernized our examination tool with Merit and enhanced integrated analytics. Merit is Ncua's configured governance, risk, and compliance tool that provides examiners with a single application to document their examination results, generate the reports issued to the credit unions, and follow up on examination concerns. We have started introducing new and improved processes and IT capabilities, including examination-specific requirements for the many types of contacts we perform in the credit unions: workflow management, data integration and analytics, and document management. Additionally, Merit provides a way for examiners to securely interact with the credit unions for the Ncua and state supervisory authorities to work jointly together on examination. And this highly configurable nature of the tool will enable Ncua to be more agile in the future and adapt to changes in the business needs. By integrating a business intelligence tool, examiners have modernized enhanced analytics to identify trends, potential risk in credit unions. The financial analytics combines several data resources together to include the call report data and provides data trends over time. These analytics are for Ncua and state supervisory authority users and do not replace financial performance reports available to the credit unions. With the future retirement of Ares, we also needed a way to ingest credit union member loan and share data and saw an opportunity to modernize this process as well. The Data Exchange application, also known as DEXA, is a new application available to Ncua Connect to Ncua credit unions and state supervisory authority users. DEXA is strictly an integration and ingest tool that provides authorized users the ability to securely upload the credit union member loan and share data requested during examination and supervision process. To minimize the impact on credit unions and data processing vendors, the tool utilizes the same schema that we have for many years, provided in the Ncua letter to credit unions 03-CU-05. It includes a history of file uploads, data mapping, processes, and validation reports. So look forward to more information on these exciting applications as we start and train and grant access to the industry in 2021. That concludes my project overview. I will now address the Merit security. Next slide, please. So information security is a top priority throughout the system development lifecycle. The overall system design, configuration, and management process used aligns with industry standards and best practices, with great care being given to protect sensitive information such as personally identifiable information. The overall Merit security model is shared with credit unions, SSAs, Ncua, and our service providers, all having shared responsibility for ensuring security. Merit and its associated systems are built on an infrastructure that is thoroughly reviewed, ultimately certified by the Federal Risk and Authorization Management Program, called FedRAMP, cloud, and it's a security process. The team placed significant emphasis on technical controls, including but not limiting to the denial of service mitigation, multi-layer encryption of information both in transit and at rest. The team also relied on implementing strong administrative and physical controls, including but not limited to rules of behavior, physical and personal security, configuration management controls, and routine security training. Credit unions and state supervisory authorities users' responsibilities are clearly outlined in the rules of behavior and an SSA Memorandum of Understanding. The Ncua partners' responsibility are clearly defined in the service level agreement and verified by a third-party auditor. As a federal agency, Ncua must also comply with security standards for federal information systems, to include all National Institute of Standards and Technology, known as NIST, standards and guidelines. Also, Office of Management and Budget policies, federal laws such as Federal Information Security Management Act, known as FISMA. And to ensure compliance, Ncua conducted an independent IT security review as part of our systems authorization process. And finally, as part of the operations, Ncua Cybersecurity Incident Response Center and our Security Operations Center, subject matter experts, monitor the Ncua network, merit, and related infrastructure for security incidents, anomalies, and other potential adverse events. That concludes my portion of the briefing. Kelly Lay is our Director of Business Innovation. She will now share additional project details on the next slide with you. Over to you, Kelly.
Thank you, Rob. I will be starting with slide 6. The Ncua utilized a methodical, organized approach to the project to ensure we were accountable and prudent stewards of the allocated funds. As mentioned, there were many components to this first project, from the underlying infrastructure to the applications examiners and credit unions will interact with. Therefore, we engaged in leading-edge market research for a commercial off-the-shelf suite of applications to replace existing functionality and enhance our examination program. Once the initial set of applications was selected, we refined our requirements and delivered the first release within 15 months. The first release in September 2019 included the underlying infrastructure, data integration, Ncua Connect, Merit, and financial analytics. The second release, deployed in July 2020, included more data integration, new applications on Ncua Connect, the data exchange application, the admin portal, updates to Merit for all types of exams completed in credit unions, new loan and share analytics, and updated financial analytics. The project is now in an operations and maintenance phase with regular enhancements, fixes, and technological upgrades. Our team did not underestimate the impact and significant nature of these changes on our user community with a modernization of this size. We wanted to ensure it was pilot tested by a group of users before the broader rollout originally planned for third quarter 2020. The following groups, comprised of 50-plus people, participated in our first pilot: the Ncua examiners and staff from the Office of National Examinations and Supervision, federal credit unions with assets greater than $10 billion, and the 2 federally insured state-chartered credit unions with assets greater than $10 billion in North Carolina and Washington, and the North Carolina and Washington State Supervisory Authorities. Through this pilot, we received valuable feedback and suggestions from all users, resulting in identified enhancements. We prioritized these enhancements with other work needed for the second release, and were able to configure forms, create reports, and update the analytics. Due to the COVID-19 pandemic, the Ncua made the decision to delay the training rollout originally planned for the third quarter of this year. Due to the significant change in technology, there is a desire to conduct in-person, hands-on training that was just not possible. However, our momentum did not falter, and the team delivered all planned functionality on schedule. With the training delay, we also saw an opportunity for an extended pilot with an additional 100-plus users from the Eastern, Southern, and Western regions, and 17 more credit unions of varying asset sizes. The Office of National Examinations and Supervision is also continuing to pilot Merit for the natural person credit unions, but also added 7 corporate credit unions and the Wisconsin State Supervisory Authority. The total number of pilot participants now exceeds 200 users and includes 31 credit unions. The expanded pilot has already started, and we look forward to the feedback from these users. Slide 7's up. Throughout this modernization, our team continually looked for ways to improve communication and interact securely with credit unions. My business innovation team working on this project includes over 100 years of combined examination experience. We understand the perspective and needs of examiners and credit unions and want to provide functionality that improves the examination process. First is the ability to securely transfer documents to an examiner. By configuring out-of-the-box functionality, examiners can send a document request list to a credit union through Merit. The credit union user will receive an email notification indicating they have a survey request. The user will log into Ncua Connect, open Merit, and can attach documents to the form. Once complete, the credit union will submit the form back to the examiner in Merit. The documents are automatically associated and stored with an examination and available to the examiner and their team members. Credit unions can also add other credit union users as collaborators to assist with completing these requests if desired. Additionally, there are several reports available that can be generated on demand. These reports provide a list of all document requests submitted through Merit with links to the actual form submitted to the examiner and the documents provided. The second benefit I would like to highlight on slide 8 is the ability to securely access and download examination reports from a central location. The credit union dashboard in Merit includes an Exams tab with a list of exam reports issued through Merit. Credit union users can receive an email notification when their exam report is ready and can log in to retrieve their report. Merit also retains a history of exam reports, so if the credit union needs to download a copy at a future date, it will be available to them. Finally, you'll see on slide 9, Merit provides the opportunity to respond to examiners and formally request due date changes on examination findings. With today's process, credit unions frequently provide status updates to examiners through email or phone or discussions during examinations. Although effective, we have found examiners and credit unions are often manually tracking compliance with examination concerns until the next exam report is issued to the credit union. The functionality in Merit offers an electronic solution. In Merit, a credit union user can be assigned an examination finding or document of resolution item. This will appear on their issues dashboard. The user can track the finding, and once they have completed any required actions, can send their response to the examiner through a configured workflow. The examiner will receive an email notification and can close out the finding or send a communication back to the credit union. Additionally, the credit union can formally request a due date extension through Merit if they need more time to correct the examination concern. There are integrated reports that show the status of examination findings and document of resolution items. These reports include current and resolved exam concerns that have been entered into Merit. These reports can be generated on demand, provide transparency, and will assist credit unions in tracking examination concerns and their current status. To recap for you on slide 10, the Ncua's Enterprise Solution Modernization Program includes underlying goals of providing emerging technology, a single point of access to applications, and enhanced analytics to provide value and create a positive impact for both Ncua staff and our stakeholders. The modernized solutions discussed today are integrated and allow users to access information needed for the examination from one platform. Always keeping the end user in mind, we streamlined forms and processes to reduce redundant data entry. Although Merit can't do everything, the application is flexible and will continue to evolve with feedback from our users and changes in our examination program. As the Ncua's modernization efforts continue, we have an opportunity to integrate applications and data from other sources for centralized access and view of a credit union. This will also benefit agency staff so they have one place to find information about a credit union. We also foresee the capacity for more off-site work by continuing to enhance our analytics capabilities, potentially leading to earlier risk identification. Hopefully our presentation today has inspired our stakeholders about what's to come with Merit, shown on slide 11. Our rollout training for Ncua and state supervisory authorities is currently scheduled for the third quarter of 2021, assuming we are able to resume on-site operations and travel by then, almost one full year from now. Once these users are trained on Merit and the associated applications, we anticipate a phased access for credit unions to Ncua Connect and Merit. We will provide user guides and training materials to assist with this transition. We are committed to communicating about these changes and anticipate the following in 2021. A letter to credit unions about the modernization and new applications, updates to the Enterprise Solution Modernization web pages on the Ncua website, and training on Merit and the related systems. In closing, I would like to thank the board for your support of the Enterprise Solution Modernization Program and the Examination and Supervision Solution and Infrastructure Hosting Project. This achievement would also not have been possible without the executive support across the Ncua, the collaboration with all Ncua offices and regions, and the partnership with our Office of the Chief Information Officer. It is amazing what can be accomplished when people come together to achieve a common goal. Thank you for your time. We welcome any questions you may have.
Great. Thank you all for such a thorough and informative briefing about the status of our examination and supervision solution and infrastructure hosting project, and specifically Merit. I personally had a chance to see various aspects of Merit during several of the staff training sessions, and I was especially impressed with what I was able to see regarding the financial analytics. I was also impressed by the tool's capabilities to provide a consistent and standardized examination and supervision process, as well as better data and analytics to identify trends and potential risk in credit unions for scoping the examination. Although this project has been one of the agency's largest capital expenditures to date, the NCUA staff, state supervisory authorities, and the credit union industry will certainly benefit from the modernization of our examination software and enhancement of our secure infrastructure that will support future modernization initiatives. Some of the benefits that Kelly highlighted, such as the ability to securely transfer documents to an examiner, securely access and download examination reports, and provide status updates on findings or request due date changes, will greatly improve the examination process. I know it was disappointing for the team to delay the rollout of Merit in 2020 given the global pandemic. But since we are still able to deploy on schedule, I am glad that we're able to pilot Merit with more NCUA and state supervisory authority staff and credit unions. This will only benefit our staff and credit unions in the long run as we take advantage of the additional time to seek feedback and enhance the tool. Feedback from system users is valuable, and I know the team looks forward to working with those users during the pilot phase. Now that we are in the operations and maintenance phase of the project, the timing is right as we review the response to our request for information on the virtual examination tool and determine how Merit may be able to further support this capability. The opportunity to integrate applications and data from other sources for centralized access and view of a credit union's files fits perfectly with this initiative. With that in mind, I do now have a few questions. Kelly, why don't we begin with you? I was glad to hear how your team has included a few state supervisory authorities in the Merit pilot phase. Can you please share a little bit more about how the state regulators have been involved with the project?
Yes, thank you, Chairman. So we involved the state supervisory authorities in the early stages of the project, and we continue to work with them on this modernization journey. We included 2 states, as I mentioned during my remarks, North Carolina and Washington, in the first pilot release. And then we just added a 3rd state, Wisconsin, for that extended pilot that begins this month. One of the other things that my team does is we host a state supervisory authority working group, and we meet with them bi-monthly. And then we also participate on the Ncua State Supervisory Authority Working Group that our Office of Examination and Insurance runs. And we've developed a joint memorandum of understanding to document our responsibilities as owners and users of Merit. And then I would also say that we've made every effort to update state regulators through various conferences and our webinars. That concludes my response.
Great, thank you. Kelly, what are some of the key areas of improvement to our current security posture delivered as part of the project? And there may be someone else who's better suited for that. I was thinking about that, Rob. As soon as I think about Kelly, that may be best in your bailiwick.
Yes, sir, Chairman Hood. This is Rob Foster, CIO. So Merit includes a number of security improvements with key highlights including three specific ones I'd like to address. One would be our multi-factor authentication service. So multi-factor authentication is something you have and then something you know, and that is state-of-the-art. That's what people are using. We also have a granular role-based security model, which has additional enhancements, which limits the access to personally identifiable information. And then lastly, I would highlight the Federal Risk and Authorization Management Program called FedRAMP, Certified Infrastructure. It's continuously monitored, highly segmented with layer encryption, and it includes built-in redundancy to ensure availability. And FedRAMP is a government-wide program that provides a standardized approach to security assessments, authorizations, and continuous monitoring for cloud products and services. And that would conclude my answer, sir.
Great. Thank you, Rob. I understand the NCUA is the first of all the FIREA agencies to modernize this examination tool using a commercially available off-the-shelf product rather than a custom-built solution. So as a result, Merit may in fact be a tool other regulators will want to emulate. In fact, I talk about Merit at a lot of my Fdic meetings and a lot of the other engagement opportunities that I have with our peers. Has anyone engaged any of the other Fdic agencies directly about our modernization efforts here at NCUA?
Chairman, this is Kelly, and I will take that question. Yes, we have met with both the CFPB and the Office of the Comptroller of the Currency to discuss our modernization efforts, and we provided them a demonstration of Merit as well. Our plans are that once we finish this next round of virtual training for the extended pilot, we also want to reach out to the FDIC and the Conference of State Bank Supervisors. We really do find great benefit from sharing with our sister agencies. That concludes my response.
Great, thank you for that, Kelly. And again, I'd just like for the record to note that we are the first regulatory agency to come up with a new modernized system around examinations. It replaces our old legacy system as ARES, and again, I think the benefits are just phenomenal. Final question, can you please provide some clarification about how credit unions will be phased into becoming users of Merit and how they can learn more as we get closer to the rollout? I know there's going to need to be a lot of communications and training efforts, so I don't know who wants to take on that question.
Yes, this is Kelly, and I'll take that question as well. I know that this can be a little bit confusing, so I'll give some examples. We anticipate credit unions will be phased into using Merit at their next exam or supervision contact after we deploy to NCUA and SSA staff. So let's assume the world returns to a new normal and we are able to train staff in the third quarter of 2021 as currently planned. A credit union whose exam, let's say, is scheduled for November 2021 may become a user of Merit a few months in advance of that exam, so possibly September or early October of 2021. But a credit union that actually had their exam in, let's say, May of 2021 may not become a user of Merit until 2022. So that's how we anticipate phasing in that access to ensure that it corresponds with their next exam or supervision contact. That concludes my response.
Thank you, Kelly. And again, I've been excited about Merit from the day I rejoined the agency and learned about its impact and what it can do, and certainly look forward to 2021 to when we do get it rolled out. And I look forward to offering any assistance that you may need in the future. I have no further questions. I'm now going to turn it over to Board Member Harper.
Thank you so much, Mr. Chairman. And building off of your observation that we've been sharing our tool with other federal regulators, as I have gotten into the field, one thing that I have heard is about some of our state sister agencies which do both credit union and bank examinations, that they have been looking, the bank examiners have been looking over the shoulders of the credit union examiners as we've been piloting this tool, as well as doing some training and briefings. And there is a bit of real interest on the bank side in order to get a similar tool. So we are certainly ahead of the curve. Kelly, Rendell, Rob, thank you for your excellent update on the Modern Examination and Risk Identification Tool, or Merit System project. Three of the main tenets of my philosophy on regulation are that the NCUA should be innovative, forward-looking, and risk-focused. Just as the world changes, a regulator must itself innovate in response to new marketplace and technological developments. An important way in which the NCUA is currently innovating is through the implementation of Merit. To remain forward-looking and risk-focused, a regulator must also revise the rules, procedures, and tools it uses from time to time. Merit will help this agency to better perform its functions and apply better analytics. It should also lead to fewer on-site examination hours, as you noted, Kelly, which will help the agency to be more efficient, another part of my regulatory philosophy. Our timely implementation of Merit underscores that the NCUA is forward-looking. With the onset of the COVID-19 pandemic, the agency was forced to move its exam processes to a virtual format literally overnight. Once operational, Merit will ensure a better and more seamless off-site exams. Kelly, could you please explain additional ways in which Merit will enable the NCUA to be more forward-looking and risk-focused?
Yes, this is Kelly, and thank you for the question. I can think of multiple examples of how Merit supports NCUA being more forward-looking and risk-focused. First, it resides on a modernized, secure infrastructure, and we can easily integrate other applications or data, which may serve us very well in the future for our virtual exam program. The tool was also configured with our risk-focused examination program in mind, and we can easily configure that to support any changes in our examination program in the future. We also have established a schedule to regularly update and keep the system current. Another example, additionally, an examiner can easily add required scope items, but we've also given them the ability to add ad hoc scope tests based on potential risks to document their review. The new financial and loan and share analytics we've also developed. We use subject matter examiners and analysts from the regions and several offices to ensure that our visualizations answered very important questions about the data and presented characteristics that may be considered red flags. Those indicators, which can be accessed outside of the examination process, can also help NCUA identify potential negative trends or risks so examiners can initiate discussions with credit unions. That concludes my response.
Thank you so much, Kelly. Last fall, you and your team began piloting Merit, and those pilots have helped the agency to work through some of the technological kinks that are typical in a project of this magnitude. And in the months ahead, before we complete the wide-scale rollout next year, we will be able to make further adjustments after gathering material from the extended pilots. Kelly, I have several questions for you about the pilots. First, what sorts of issues surfaced during the pilots with one's credit unions and our partner state regulators, and how were those issues resolved?
Yes, this is Kelly. So like any new tool, of course, we found bugs that we fixed through regular updates to the system, but I would say we received the most feedback from credit unions, state regulators, and our own NCUA staff on the survey functionality. So credit unions, one of the things they requested was a report to see all document requests returned to an examiner, and I'm happy to report that we were able to use that feedback to improve the user experience. We added a report so a user can easily track which surveys have been completed and what documents have been sent to the examiner. The credit union can view those survey responses as well. We also provided additional training and updated user guides to improve the understanding of the survey process. Some of the other feedback that we received from state regulators and NCUA staff was a request for a consolidated report in Merit to show the documents requested from the credit union. So with surveys divided by review or risk area, they were concerned that they might actually send a duplicate request to a credit union, and we wanted to definitely avoid that to improve the efficiency of this process. So a report showing that all requested documents and the status is also available in the July release of Merit. I would just add that we're really excited about the expanded pilot in obtaining even more feedback from credit unions and other functionality in Merit. That concludes my response.
Kelly, thank you so much. And certainly when I have been out in the field, I have heard about the control of documents issue, at least initially, and I'm very pleased to hear that you and your team have worked through those kinks to improve efficiencies and help to exams to go smoothly. My next question for you relates to some states like Washington, Illinois, and Massachusetts conduct separate consumer compliance exams and provide a consumer compliance rating of their regulated credit unions. Is Merit equipped to document state consumer compliance ratings, and if so, how?
Yes, this is Kelly, and absolutely it is set up to do that. So we were aware and spoke with several of these states, as well as our Office of Consumer Financial Protection, during the Merit development. As a result, we configured specific contact types in Merit for compliance exams and added an optional compliance rating to the Camel form for those states that issue a compliance rating. States can also use the compliance job aids in Merit. They can add scope tests specific to their regulations, and they can document a compliance risk rating and merit as well. That concludes my response.
Thank you, Kelly. That's really helpful to know, because if the NCUA were to begin to assign separate consumer compliance ratings the way our sister federal banking agencies do, we could easily make that change in our supervision program without needing to make major alterations in merit. Overall, Kelly, I can tell you that as I've gotten into the field, I have certainly heard that the merit system that you and your team, along with Rob and Rendell, have been developing has received very high marks. I do want to encourage you to keep up the good work. Thank you for answering all of my questions and for this helpful briefing. Mr. Chairman, I have no further comments at this time.
Thank you, Mr. Harper. I'd now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. I have no specific questions, but wish to express my thanks to the merit staff for their diligent work and rigorous and demanding efforts on this project that we started several years ago when it became all too apparent to the board that Ares had met its sell-by date. It's been a long journey over the years, and I specifically want to congratulate and thank Kelly and Rob, Rendell, and your teams for your prodigious efforts. This will have long-term positive consequences to the NCUA and reduce the regulatory burden of examinations, which was our underlying goal when we christened the merit program several years ago. Thank you.
Great, thank you. The third item on our agenda today is Bank Secrecy Act, Customer Identification Program Exemption. Staff presenting, Tim Segerson, Deputy Director, Office of Examination and Insurance, and Ian Marina, Associate General Counsel, Office of General Counsel. Good morning.
Good morning. This is Ian Marina. We are here today to recommend authorizing the acting E&I Director to sign, on behalf of NCUA, a joint interagency order exempting customer identification program requirements for certain loans granted by banks, credit unions, and affiliates and subsidiaries to finance property and casualty insurance policies. The E&I Director previously received board approval to exempt commercial property and casualty finance arrangements. The agencies issued the relevant order in September 2018. Industry groups subsequently sought expanded coverage of the exemption to include all property and casualty financing arrangements beyond commercial property and casualty financing arrangements. Under the regulations implemented by the Financial Crimes Enforcement Network, known as FinCEN, within the Department of the Treasury, credit unions and banks are required to implement a customer identification program that includes risk-based verification procedures to enable a credit union or bank to form a reasonable belief that it knows the true identity of its customers. Under the implementing regulations, the appropriate federal banking agencies, which includes the NCUA, with the concurrence of FinCEN, may exempt a credit union or bank from the customer identification program requirements upon consideration of whether the proposed exemption would be consistent with the purposes of the Bank Secrecy Act, safe and sound banking, and other appropriate factors. This is the authority under which the NCUA, the other federal banking agencies, and FinCEN granted the September 2018 exemption order that I mentioned at the outset. The federal banking agencies received requests in November 2018 to expand the September 2018 order to cover all property and casualty finance arrangements. As with commercial property and casualty financing arrangements, after a review and careful consideration of the nature of these transactions, the NCUA and its fellow banking supervisors concluded the activity did not present a safety and soundness risk, posed minimal money laundering risk, and was consistent with the purposes of the Bank Secrecy Act. FinCEN has concurred with this finding as required by regulation. Deputy E&I Director Tim Segerson will now discuss the financing arrangements in greater detail. Tim?
Thank you, Ian, and good morning. This is Tim Segerson. Property and casualty insurance policy financing is a specialized type of lending handled through an insurance company or broker as an intermediary. The bank or credit union or affiliate does not typically interact with the borrower, who would be the insured party. Rather, the arrangement is handled directly to a broker or agent or insurance firm. Payments are typically remitted to the insurance company, who then remits payments to the lender. Cash exchange to fund the credit arrangement does not occur between the borrower and the lender. Rather, it's transmitted directly to the insurance company at funding and collected directly from the insurance company if the policy is canceled or terminated. The Customer Identification Program regulation requires identity verification by the lender. This creates a disadvantage for banks and credit unions, lenders, as those same requirements are not applicable to the insurance providers and unnecessarily delays an immediate turnaround type of transaction or point-of-sale transaction. Considering the low-risk nature of this type of financing arrangement, Ncua, along with the other banking agencies, seek to provide an exemption specifically for these types of commercial and personal property and casualty financing arrangements to reduce burden and improve efficiency in this low-risk activity. The exemption order may be revoked upon learning of a possible money laundering or terrorist financing risk not previously identified or disclosed, or if the transaction type undergoes a structural change that would increase its risk. In addition, the exemption is limited exclusively to property and casualty premium finance arrangements for commercial and personal insurance contracts. Finally, these types of financing arrangements remain subject to all of other BSA requirements, including the filing of suspicious activity reports. As a result, we seek your approval to authorize the acting director of the Office of Examination and Insurance to sign a joint agency exemption order on behalf of Ncua and to make any necessary non-substantive edits to the order prior to issuance should the need arise. With your approval, Acting Director Tepe will sign the order at a subsequent time upon all agencies' approval. That concludes our remarks, and we're happy to answer any questions you may have. Thank you.
Thank you for your presentation this morning. Can you hear me? Oh, thank you. Thank you for your presentation this morning and for your work on this matter, along with FinCEN and the other federal banking agencies. The Customer Identification Program requirements under the Bank Secrecy Act regulations are an important tool to deter and prevent money laundering or terrorist financing. In considering today's proposed exemption, I want to underscore that credit unions have a vital role to play in combating these crimes by maintaining effective customer identification and other Bank Secrecy Act related programs. However, I am pleased that we are able to consider this targeted relief in the form of an exemption order for this class of transaction. This order supersedes the September 2018 order previously issued by the agencies jointly and would expand the relief in a deliberate fashion to all property and casualty customers after all the agencies carefully considered the appropriate regulatory factors. Therefore, I intend to vote in favor of the proposed action to authorize the acting E&I director to execute the joint order, along with her counterparts at the other federal banking agencies, as part of this joint action. I now, gentlemen, have a few questions. What if you later determined that a financing arrangement like this contained increased risk of money laundering or terrorist financing?
Chairman, this is Tim Segerson, and I'll answer that question. The federal banking agencies reserve the right to take any action necessary under the BSA, including a revocation of the order.
Thank you. Are there any consumer protection implications?
Chairman, this is Ian Morena. I will address that question. A financing arrangement handled through a credit union or a bank provides consumer protections that are applicable to borrowers. And in fact, the exemption order states directly that a credit union or bank remains subject to all applicable consumer protection laws. That concludes my response.
And one final question. Do credit unions engage in premium financing arrangements?
Chairman, this is Tim Segerson again, and I'll answer that question. We don't specifically collect information related to premium financing arrangements on our call report information, and it's not an area of focus with examinations specifically. However, in our interactions and communications with regional offices, we have learned that there are some credit unions that are involved in this type of lending. Thank you.
Thank you, and I have no further questions. I'd now like to recognize Board Member Harper.
Thank you, Mr. Chairman. I will keep this short. Tim and Ian, first of all, thank you for your informative presentation. I will vote to approve the exemption order granting exemption from the Customer Identification Program requirements for loans extended by financial institutions to commercial customers for purchases of property and casualty insurance policies. This narrowly tailored exemption presents a low risk for money laundering, terrorism financing, and safety and soundness. Approving the exemption will provide targeted relief for those institutions that supply such financing and allow them both to remain competitive and to better serve their members. Thank you, Mr. Chairman. I have no further questions or comments at this time.
Thank you. I'd now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. I have no questions, but wish to thank Tim and Ian and their staffs for their diligent work on this matter. Good job, guys. That's all I have.
Great, thank you. Is there a motion?
Yes, this is Board Member Harper. I move that the board authorize the acting director of the Office of Examination and Insurance to sign the Interagency Customer Identification Program exemption ordered as detailed in the board action memorandum.
Is there a second to the motion?
Yes, Mr. Chairman, this is Mark McWaters, and I second the motion.
There is a sufficient second. All in favor say aye.
Aye.
Aye. All opposed say nay. The ayes have it, and let the record show the motion pass 3-0. Thank you, everyone. The fourth and last item on our agenda today is Interim Final Rule, Part 722, Real Estate Appraisals. Staff presenting Lou Pham, Senior Credit Specialist, Office of Examination and Insurance, Ian Morena, Associate General Counsel, and Gira Bose, Staff Attorney, Office of the General Counsel. Good morning, everyone.
Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. This is Lou Pham from the Division of Credit. The fourth item on the agenda is a final rule that provides temporary appraisal relief for credit unions and their members. This final rule is a product of the interim final rule that was approved by the board back in April of this year. We collaborated with other banking agencies on the interim final rule and this final rule. So although the final rule isn't an interagency rule, it is similar to the other banking agencies, and credit unions receive the same treatment as banks on this matter. As you may recall, the April IFR allows credit unions to defer appraisals or written estimates of market value for certain real estate transactions that require these types of valuations for up to 120 days after loan closing, with a sunset on December 31st, 2020. This relief is necessary due to the ongoing COVID-19 emergency to provide flexibility and liquidity to real estate markets and allow homeowners and small businesses access to real estate equity during the emergency. We received a handful of comments from the credit union industry on the IFR that was supportive of this temporary appraisal relief. With this rule today, we are simply converting the interim final rule into a final rule. There are no substantive changes from the IFR to this final rule. Transactions that are eligible under this final rule continue to include all residential real estate and commercial real estate loans, with the exception of acquisition, development, and construction loans. Provide maximum flexibility to property owners. There is no limit to a transaction size. A credit union that defers the appraisal or written estimate must obtain the required valuation within 120 days after loan closing. They must continue to underwrite loans in a prudent manner by addressing borrower repayment capacity and an estimate of the collateral value, among other items. And they should have a risk mitigation plan in place in the event the real estate collateral is subsequently valued at a lower amount than expected. Given the ongoing COVID emergency, this final rule will help provide liquidity and flexibility for credit unions, their members, and real estate markets in general. We request approval from the board on this final rule. Thank you, and that concludes my remarks.
Great, thank you. Given the ongoing severity of the COVID-19 pandemic, I think the interim final rule and now final rule on appraisal deferrals makes sense. The current public health crisis and subsequent social distancing directives have created difficulties for lenders to obtain required appraisals on a timely basis. As a result, borrowers may be prevented from refinancing loans and gaining access to much-needed equity on their real estate in these uncertain and challenging economic times. Access to credit is the lifeline of many communities and families and will be necessary for them to recover from any economic damage done by the COVID-19 pandemic. By deferring appraisals and evaluations up to the 120 days, this rule will help bring relief and liquidity to homeowners and businesses. This rule allows credit unions to serve their member owners who are looking to buy or sell real estate or gain access to their real estate equity during the pandemic without the worry of a delay because an appraisal could not be completed in a timely manner. According to recent mortgage data from the National Mortgage Database, the forbearance rate is relatively low for credit union mortgages during the COVID-19 pandemic. 3.6% of credit union mortgages are in forbearance compared to 7.2% of mortgages originated by other mortgage lenders. Removing this potential roadblock allows credit unions to efficiently operate their real estate lending business and helps with the smooth functioning of real estate markets and helps the ailing U.S. economy begin the recovery phase. I just have one question. The rule will sunset on December 31st, 2020, which is a little more than 3 months away. Have we and other banking agencies looked at extending the sunset period, especially if the pandemic persists through the end of the year?
Thank you for your question, Mr. Chairman. We didn't extend the sunset period with this final rule. However, we received several comments about extending the sunset period during the IFR. As we approach the end of this year, we will work with our banking agency partners and consider an extension of the sunset if conditions warrant an extension at that time. Thank you.
Thank you, and that is a posture that I would certainly support, so thank you. I have no further questions. I'd now like to recognize Board Member Harper.
Thank you, Mr. Chairman, and Lou, Gira, and Ian, thank you for your presentation, and my thanks to everyone from the Office of Examination and Insurance and the Office of General Counsel who worked on this final rule on real estate appraisal relief. Back in April, when state and local government officials implemented restrictions on non-essential movement, stay-at-home orders, and social distancing mandates to fight the spread of COVID-19, it became clear that this rule made a lot of common sense. For as we understood it, these scientist-recommended efforts to fight the pandemic could also make it harder to complete appraisals before a mortgage transaction closes. Yet precisely at the same time, mortgage rates had fallen significantly and consumers wanted quick access to credit at lower rates. Our decision to provide such temporary and targeted relief was sound. For, as we have seen, one of the few bright spots in our pandemic-wracked economy is the U.S. housing market. Home sales have remained strong. Our interim final rule contributed to the ability of credit unions to provide their members with a quicker reduction in monthly mortgage payments and expeditious access to less expensive credit. For families who have experienced declines in household income because of COVID-19, these refinancing opportunities may be the lifeline needed to get back on their feet. I should emphasize, as I did earlier, when we first considered the interim final rule, this temporary short-term deferral of an appraisal is not a waiver of an appraisal because appraisals and written estimates of market value are being deferred, not waived. As I noted in April, credit unions will need to take steps to document the value within the required deferral timeframes. In sum, Mr. Chairman, I will vote for this short-term regulatory change. Thank you for the time. I have no questions for staff and no further comments.
Thank you, Mr. Harper. I'd now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. I have no questions, but wish to thank Lou, Ian, and Gira for their work on this matter. Thank you.
Yes, thank you. Is there a motion?
Yes, Mr. Chairman, this is Mark Waters. I'll make the following motion. I move that the board approve final rule, part 722 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed say nay. The ayes have it, and let the record show the motion pass 3-0. Thank you, everyone. Last week, the NCUA board unanimously approved temporarily promoting Melaine Conyers-Osbrooks to the position of Secretary of the Board. I'd be remiss if I did not also recognize and thank Jerry Poliquin for his 7 years of dedicated service as Board Secretary. I'm happy to announce that he isn't going too far. Jerry will be rejoining the Office of General Counsel as a trial attorney. Over the next month, Jerry will work with Melaine in performing the Board Secretary function to ensure a smooth transition. Jerry, in the year and a half that I've been at the agency, I would sincerely just like to thank you for your dedicated service as Secretary of the Board. Thank you for your diligence and professionalism, and you will be greatly missed. But again, we will still get to enjoy working with you and seeing you, hopefully in person when we someday return. But again, thank you for a job well done. And Melaine, I'm happy to have you serve as our Board Secretary, and I look forward to working with you in the days ahead. Now that I have had a chance to thank Jerry and welcome Melaine, I'd be remiss if I did not allow my fellow board members to also thank the Board Secretary, as they too have worked with him for quite some time. Why don't we begin with you, Mr. Harper?
Absolutely. Thank you, Mr. Chairman. When I think of Jerry, several adjectives come to mind. They include calm, measured, unflappable, detail-oriented, dedicated, thoughtful, and precise. These are the qualities that you want in every board secretary, and they have allowed Jerry to make the job look easy. In reality, it is not. The job of a board secretary is one of herding cats, resolving technology issues, prodding staff to submit proper documents, organizing comment letters, and getting board members to turn in notation votes on time, along with many, many other substantive responsibilities. During the last 6 months, as we have operated in a remote posture, I have deeply missed Jerry's presence, and I've figured out just how much he does behind the scenes. In particular, I've had to prepare my own issue binders in advance of board meetings. Until now, because of Jerry, I had taken for granted the timely delivery of the most up-to-date materials I needed in advance of important votes. The reality is, I wish that we could clone Jerry and deploy a version of him with each of us in the week before a remotely held board meeting. He makes everything run more smoothly. As you noted, while Jerry is leaving one job at the NCUA, I'm very pleased that he's stepping into another role at the Office of General Counsel. We will be able to continue to benefit from his institutional knowledge, reliability, and professional expertise. And when we return to the office at the appropriate time, I plan to stop by Jerry's new office to compliment his dapper, preppy fashion sense and chat about sports, food, and travel. And if it's permitted under the ethics rules, I may even surprise him with a pair of my brightly patterned paisley socks to replace his standard issue black and navy knee highs. But seriously, Jerry, my very best wishes for you as you begin this next phase of your professional journey. And thank you for all that you have done to maintain high standards for the agency over the last 7 years. Before I close, I also want to welcome Melaine Conyers-Osbrooks as the new NCUA Acting Board Secretary. I know that she is up to this challenge, and my team and I look forward to working with her. Thank you, Mr. Chairman. I have no further comments.
Great. Thank you, Mr. Harper. I'd now like to give Board Member McWaters an opportunity to speak.
Thank you, Mr. Chairman. A few years ago, probably 20 years ago, I went to a golf tournament with my 5-year-old son, and he wanted to follow Tiger Woods, and so we did for a few holes. And after that, he looked at me and says, "Hey, Dad, golf looks really, really easy. There's just nothing to it. I think I want to play golf." And, you know, I told him at that time that was one of life's lessons, that people who do things really, really well, they make it look seamless. They make it look easy. And that's what Jerry did. I mean, I've been on the board now for over 6 years. I've been to countless open meetings, closed meetings, notation votes. Everything went well. Nothing was ever messed up. Jerry always got it right. He made the job look easy. So, Melaine, I'll give that to you as some free advice. What looks like an easy job was actually a very difficult job, very challenging. Being behind the scenes, leading up to a board meeting and the flurry of activity and the changes going on. Jerry was unflappable, and he gave me the type of confidence you need in a person where you can say, I'm going to worry about my job. Because Jerry has this board secretary stuff down. I don't have to think about it. I can just simply walk into the meeting, and I absolutely know it's going to go well. Just like I know absolutely well when Tiger Woods hits a 1-iron, it's going to go well. So, Jerry, thank you. It's been an absolute pleasure, an honor to work around you. You're a credit to the NCOA, credit to the bar, and good luck back in GC. And Melaine, welcome to you. I look forward to working with you also, and I wish you the very best. Thank you, Mr. Chairman.
Great. Thank you both. And again, we all wish you the best, Jerry, and Melaine, welcome. That, ladies and gentlemen, is the end of our agenda today. There being no further business, we are hereby adjourned.